Okay, so Ivor Limited produces a single product. The company's profit and loss account for the year ended 31st of the 12th, 2010, during which 90,000 units were produced and sold, was as follows. So sales, 90,000 units, 1.17 million. Materials, 390,000. Direct labour, 236,000. Factory overheads, 82,000. Selling expenses, 105,000. Administration expenses, 130,000. So altogether there you have costs of 943,000. When we take that from our sales, we get net profit 227,000. So the materials, direct labour and 40% of the factory overheads are variable costs. Apart from sales commission of 5% on sales, selling and administration expenses are fixed. You are required to calculate A, the company's break-even point and margin of safety, B, the number of units that must be sold in 2011 if the company is to increase its net profit by 20% over the 2010 figure, assuming the selling price and cost levels and percentages remain unchanged. C, the profit the company would make in 2011 if it reduced its selling price to €11, increased fixed costs by €15,000, and thereby increased the number of units sold to 110,000, with all other cost levels and percentages remaining unchanged. D, the selling price the company must charge per unit in 2011 if fixed costs increase by 12%, but the volume of sales and profit remain the same. E, the number of units that must be sold at €16 per unit to provide a profit of 10% of the sales revenue received from these same units. F, number 1, list and explain 2 limitations or assumptions of marginal costing. And 2, explain what is meant by a step fixed cost and roughly sketch a graph of step fixed costs using the following rental payments. So as you can see there, the entire question 8 this time, the entire question 8 is made up of the marginal costing question. So we can see at times question 8 could be a part A, part B, part C, but this year, 2011, the entire question was made up 80 marks, marginal costing. Okay, so as per usual, you should know these ratios. If you don't know them, pause the video now and read over them and make sure you know them before taking the video forward. Okay, so as per usual, what we have to do now is we have to do a marginal costing statement, which is this here at the bottom. So what we have done is we take our sales, we less our variable costs, and that is equal to our contribution, and then we take away our fixed costs, and that is equal to our net profit. Now, you'll notice this big blue box up here. It says, when there is selling commission in a marginal costing statement, you must also work out what the variable cost per unit is without sales commission as well as with sales commission. Why? If the selling price changes, so will the sales commission. Well, that makes sense. If my €13 here changes to 15, that's going to change my variable cost per unit because my sales commission will change there. Right, so let's have a look at it and break it down. So my materials here, 390. So it says the materials, direct labour and 40% of the factory overheads are variable costs. So the materials, 100% variable. Labour, 100% variable, so that goes straight in there. And then 40% of the factory overheads are variable. So 82,000 by 40%, 32,800. And then the factory overheads, 82,000 by 60%, 49,200. Apart from sales commission of 5% on sales, selling and administration expenses are fixed. So apart from sales commission of 5% on sales, so 5% of this figure here, the sales figure, is going to be commission. All right, so the commission that's going to go to the salespeople. So selling expenses here, 1.17 million by 5%, that is €58,500. That is your selling commission there, which is going to go into variable costs. So obviously sales commission will change as the selling price changes. So that is why this blue box here relates to what you see in front of you here. What we want to do is we want to get the variable cost per unit but then we want to find out what the variable cost per unit is without the sales commission. Okay, so 390,000 plus 236,000 plus 32,800, add them all together, divide them by the number of units, 90,000 units, and we get a variable cost per unit without selling commission of €7.32. When we look at all the variable costs, including the 58,500, that tots up to 717,300. So sales minus variable costs is equal to contribution. So the contribution, €452,700. So we find out what our variable cost per unit is by dividing 717,300 by 90,000 units. So that's €7.97. And then we find out what the contribution per unit. So 452,700 divided by 90,000 units is €5.03 contribution per unit. Then we have our fixed costs. So we've already looked at our factory overheads. So 60% of our 82,000. That was 49,200. Then the selling expenses are 105,000 minus what the sales commission was up here. So that is 46,500. Then the administration is 130,000. So we tot those all up and it is 225,700 euro are our total fixed costs. So overall, net profit 227,000. So as you can see, the sales hasn't changed. Okay, the net profit hasn't changed. If we added up the two costs, so the 717,300 and the 225,700, we would get the same as this here, 943,000. All we have done here is separate the costs out into the variable and the fixed elements, which is how we do a marginal costing statement. So marginal costing statement has the following format: sales less variable costs is equal to contribution, less fixed costs is equal to net profit. Okay, so part A, you are required to calculate the company's break-even point and margin of safety. So, break-even point has the formula, fixed costs divided by contribution per unit. So my fixed costs are 225,700 divided by my contribution per unit, which is €5.03, and that is equal to 44,870.78 something something something. So if you punch that into your calculator, you're going to get a lot of digits after the decimal point. However, as you know, you can't sell 0.78 something 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 of a unit. You are going to have to round up because you're going to have to sell up to the next unit in order to break even. So that is 44,871 units. If you were asked to find the break-even point in euros, you would multiply your break-even point of 44,871 multiplied by the selling price per unit, which is 13 there. The margin of safety is next. So the formula for margin of safety, sales minus break-even point in units. So my sales here, 90,000 units, minus my break-even, which was 44,871. And that is equal to 45,129 units. And again, if you were asked for that in euros, you would multiply 45,129 by 13 euro. Now, part B. The number of units that must be sold in 2011 if the company is to increase its net profit by 20% over the 2010 figure, assuming the selling price and cost levels and percentages remain unchanged. Okay, so what we're looking for here, the number of units. So this is a sensitivity analysis question. So a what if scenario. What if they increased its net profit by 20% over last year's figure, which is the 2010 figure, which is this one here, assuming the selling price and cost levels and percentages remain unchanged. Okay, so our formula for our sensitivity analysis, sales minus variable costs minus fixed costs is equal to profit. So, my sales, has anything changed my sales? So, the number of units is what I'm looking for. So, the number of units is going to be X. And the selling price there is 13 euro. Okay. So, it hasn't changed. The 13 euro hasn't changed there. Okay, we're going to minus the variable cost. Now, if my selling price has not changed, I can use the variable cost per unit that has the selling commission in it because my selling price hasn't changed. So my variable costs are going to be the number of units, which is X, multiplied by 797. Okay, so 797. So it's the exact same thing there, 797, okay, as 732, but then the 65 cents. So 732 and 65 is 797. So I can just use that figure there. Next then, fixed costs. Have fixed costs changed at all? So there is no change there for the fixed costs. So the question hasn't asked us to change it. It hasn't said that the fixed costs are going to change. But the question has said that they want the net profit to be increased by 20% over the 2010 figure, which is the 227,000. So 227,000 by 120%. Okay, so now we can work it all out. So we've got 13x minus my 797x minus my 225,700 is equal to 272,400. So we'll put all the x's over on one side and we'll take all the euros over to the far side. So we're going to have 5.03x is equal to 498,100. So my x, which is my number of units that must be sold, is equal to 99,026 units. So that's part B. Part C says the profit the company would make in 2011 if it reduced its selling price to €11, increased fixed cost by €15,000, and thereby increased the number of units sold to 110,000 with all other cost levels and percentages remaining unchanged. So again, our sensitivity analysis formula, sales minus variable cost minus fixed cost is equal to profit. So let's think about the sales first then. Has it mentioned anything about sales price or anything like that? So it has. So it's going to reduce the selling price to €11. But then that's going to increase the number of units sold to 110,000 instead of the 90,000 that they previously had. So 110,000 is the number of units multiplied by my selling price, which is 11. Then I'm going to minus the variable cost. So beware here, this is the variable cost that I'm going to use, and then I'm going to add 5% of €11, which is going to be my new sales commission. So minus the 110,000 units by 732, which is my variable cost without selling commission, and then multiplied by 55%, which is 5% of the new selling price. Then I'm going to increase my fixed costs by €15,000. So you've got 225,700 plus €15,000. And then your profit is your X. So your profit is what you're looking for, what you're being asked for in this question. So your sales, 1.21 million, minus your variable cost of 865,700, minus your fixed cost of 240,700 is equal to your profit. So your profit is €103,600. Part D of the question. The selling price the company must charge per unit in 2011 if fixed costs increase by 12%, but the volume of sales and profit remains the same. Okay, so again, your sensitivity analysis formula, sales minus variable costs minus fixed costs is equal to profit. So the selling price is what we're looking for here. So the volume of sales are going to remain the same, so that's 90,000 units, but the selling price is our X here. We don't know what our selling price is. Our variable costs, so we don't know what our selling price is, so we're going to use this variable cost per unit without my selling price. So minus the 90,000 units by €7.32, and then minus 90,000 units by 0.05, so that's a decimal for your 5%. So 5% of your X, which is your selling price. So 5% of your selling price multiplied by the 90,000 units. Your fixed costs are going to increase by 12%. So 225,700 by 112%, and that is your fixed cost there. And then your profit is going to stay the same. So there's no change there. So it's staying at the 227,000. So your sales are going to be 90,000 X minus 865,700 minus 4,500 X minus your fixed cost of 252,784, and that is equal to 227,000 euro profit. So again, we'll put the X's over on the left hand side and the euros over on the right side of the equals, and we'll get 85,500 X is equal to 1,138,584. So therefore, X, the selling price that we're going to have to charge, is €13.32 per unit. Okay, part E then. So what are the number of units that must be sold at €16 per unit to provide a profit of 10% of the sales revenue received from these same units? Okay, so how many units do I have to sell at €16 per unit to make a profit of 10%, which would be €1.60 of the sales revenue received from these same units? Okay, so again, sensitivity analysis, what if situation, what if we sold it at this? Okay, so €16. So selling price, what's your selling price going to be? It's going to be €16. The number of units, that is what we're being asked for, so that is X. Now, my variable costs, so again, up here, €13. We know that we're changing it now to €16, so we're going to use this figure here, okay? And then we're going to find out what 5% of our €16 is as well, and take that away also. So my variable costs are minus €7.32 multiplied by X, which is the number of units. We don't know what that is yet. And then minus 80 cents. So 80 cents is 5% of €16. So for every unit that a salesperson sells at €16, they're going to receive 80-cent commission on that sale. Now, have fixed costs changed? So this question doesn't say anything about the fixed costs changing, so they're not going to change. And then the profit. We know we want to make 10% of whatever the €16 is multiplied by the however many units. So it's going to be 10% of 16x, all right? So 16 multiplied by 10% multiplied by x. So 16x minus 8.12x minus no change, 225,700 is equal to 1.6x. So then we're going to take our x's over to the left hand side, and we're going to take our euros over to the right hand side. So on the left hand side, we're going to have 16x minus 8.12x minus 1.6x, and that is equal to 225,700. So we're going to have 6.28x is equal to 225,700. So sorry, there shouldn't be a euro sign there. So 6.28x, forget about that euro sign, is equal to 225,700. So x is equal to 35,940 units. Part F then is a little bit of theory. So list and explain two limitations or assumptions of marginal costing. So number one, so we've seen this before in our introduction to marginal costing video. So variable costs are assumed to be completely variable at all levels of output. So however, variable costs may decrease due to economies of scale, or may increase because of increased costs. So if you're buying in bulk, it's quite obvious that your supplier is going to give you discounts, or else you'll just go to a different supplier who is going to give you discounts. It's assumed that in marginal costing, fixed costs remain the same, although most costs are step fixed and are only fixed within a relevant range. Number three, it's assumed that all mixed costs are easily separated into fixed or variable. The high-low method can be used for this purpose, but it is not always possible to do this. Number four, it's assumed that the selling price per unit is constant and does not allow for discounts. So just like we have just seen, we would obviously be expecting discounts from our suppliers. We would obviously be offering discounts to those customers that are buying in bulk from us as well. And then production in a period usually equals sales. So fixed costs are charged in total to a period and are not carried forward to the next period. Okay, number 2. Explain what is meant by a step fixed cost and roughly sketch a graph of a step fixed cost using the following rental payments. So the rent 5,000, 12,000, 19,000, 28,000, and the output in units 20,000 units, 30,000 units, 40,000 units, and 50,000 units. Okay, explanation of a step fixed cost. So step fixed costs are costs that are fixed within a certain range of activity but change outside of that range. For example, rent could be fixed up to a certain level of production. However, if production increases and results in the rental of more factory space, then the rent would increase to a new level. Thus, the fixed cost would increase in steps. So obviously you'd use the information from the question. So it's obviously hinting at you that the costs are going to increase as the output increases there. So this is your graph of your step fixed cost there. Okay, so you can see it's just like a flight of stairs there.